This is John Klein again. We're going to get started now on our webinar, so welcome. We're going to speak today. This is at FMS University. We try to do webinars every 4 to 6 weeks. We've spoken this year a lot about PPACA, a lot about the Department of Labor overtime, which, as I think many of you are aware, has now been, it's a court issued an injunction. I noticed that the Department of Labor has filed a response to that. Likely not going to be dealt with until February, at which point we'll have a new administration, so that remains to be seen. We've done some things on lighting fixtures. We've done some others as well. Today we're going to talk about budgeting, cash planning and forecasting, and lending package RFPs. I get tons of questions this time of year. It's a period of time when cash is always tight for retailers. You stocked up on holiday purchases from your wholesaler. You have seasonal merchandise, obviously setting on very high inventory levels. So it's always an interesting time of year in terms of cash management. So from a standpoint of presentation today, I'm going to quickly cover the FMS module relative to budgeting. I've been asked many times about why don't you guys help us develop some tools and some abilities to better budget. We have done that. Spent a lot of hours this year developing some spreadsheets and some tools to gather data. So I'm going to quickly cover that. I've covered budgeting before, so I'll take about 10 minutes or so to cover budgeting from an FMS systems perspective. And then Dennis Hoyt from Hoyt Treasury will jump in and cover the cash planning and the lending negotiations. So ready to get going. I hope everybody is staying warm on this very cold December afternoon. So from an FMS perspective, we certainly advocate that budgeting is a best practice for retailers. It is the best way to ensure buy-in from your managers in terms of financial performance, as well as establish accountability for that performance. In fact, I had a meeting with one of my managers this afternoon, obviously from an accounting perspective, but my point is if we don't tell folks what success is, if we don't define it, then how do we expect them to achieve it? And so I think budgeting does the same thing. It's amazing. I've had more retailers tell me that it's the best thing that they do relative to improving performance. FMS does provide several tools for gathering history to help you compile your budget. We'll go through a budgeting spreadsheet today as well as a budgeting upload template to get it into our Focus software, so you can then write SRW reporting against those budgets. One quick note is our system will allow you to enter multiple budget instances. You can have budget 1 for your original budget. Revised budget could be budget 2. You can have quarterly reforecast. I think it'll hold literally close to 1,000 different budgets. So if that's something that's important to you and your team, if you buy stores or divest stores during the year or something competitively changes, we can hold more than one budget and write reports against each of those. So very handy. I mentioned before, I came here from Super Value. We used to do reforecast literally every month. So it is a nice feature in our system to be able to accommodate that. The first thing I wanted to cover again quickly is the ability to gather information. It's obviously the first step in budgeting is understanding where you are today and establishing the baseline to build upon. We have 2 primary tools for doing. I guess I have multiple tools, but the 2 primary tools that I use. The first one is our trial balance reporting tool. And as you can see here, you put in your corp, your stores, the account ranges. If you just wanted sales, most of our customers have a standard chart of accounts, and that is 4010. You would enter that in this section. The big thing I wanted to show today is the area that's highlighted, if you uncheck that box, it's a feature that we added a year or 2 ago, it will give you store number down the left side of your reporting that comes from that trial balance. And in this case, you can see here I've pulled the report up and gleaned it a little bit. It's got store number. The beauty of having store number in is it lets you quickly filter data, get to the point to where you want to be and work with it in Excel, and can very quickly then render it into a pivot table, which gives you an excellent sales budgeting tool just all by itself. In this case, you can see I've got stores down the left and departments across the top. You could do it the other way if you're so pleased. But you can then, once you've got this historical data, you can load it into the spreadsheet that we'll cover in just a second. and it would allow you then to budget your sales for the next year. You can parse it out by department or by store or both or by supervisor, whatever it may be. But again, so we went from trial balance reports. I unchecked that box. It gave me the raw data with store number down the left-hand column. Spun it to a pivot table in Excel. Pivot tables, I know a lot of folks sort of get a phobia. Oh, I can't do those. I literally taught myself to do pivot tables a couple of years ago in 15 minutes. I'm very rudimentary with them, but it's a pretty easy thing to learn. The second tool that we have, and probably the one that I favor, is we have the ability to use our query tool, which is Empower. Empower is accessed for us via our portal. This is the front page of the portal. This is my sign-in, as you can see. You get to that to the portal via FMSsolutions.com. Once you log in, this is the front page. You get to reporting, and you log in. The report that I prefer to use when it comes to budgeting, it just lets you get all it displays over the ledger, is what we call the 6,000 report, and you can run it for any period, any time for any stores, whichever ones you want to pull, as well as certain accounts. So you don't necessarily have to pull all the data at once. In fact, it could be quite a user of data space and system space if you decide to try to do it all at once. So run the reporting. We have a number of reports in our system. If there are other reports that you want written, contact our help desk, and we'll be glad to help with that and put it in your domain so that you can run it. So when this tool runs, the Empower, I ran the 6,000 report, excuse me, and you can tell it gives you company, corp, store. It tells you the source. It could be a JE, a cash receipt, whatever it may be, department account, sales amount, in this case by day. If you enter by day, if you enter by week, it's by week. And the thing that we've added recently to this report, at least the one that I use, is it adds GL week, which makes it really nice to write a VLOOKUP so that you can quickly put that in by period. So you can see here I took this information. It does tie nicely. I made sure it did. I took the information from here, spun it to a pivot that gives me the same information. I just did it for one store this time just for sake of brevity. But again, departments across, category departments across the top, stores down the left-hand side. You can link this then to whatever budgeting spreadsheet you have, which is the next thing I want to go through. The last several years, I've been asked, do you guys have a template that you can share with us to help us budget? And we've had some rudimentary spreadsheets set up. So earlier this year, I got with a couple of our technically astute accountants and said, let's develop a budgeting tool. So we did. And I'm going to go through this really quickly. If you would like this, if you would contact me, my email is John, JONC, @FMSsolutions.com, or your accountant, and we'll be glad to share a blank version of this. This one's one that's filled out a little bit that we use for demo purposes. The first thing we do is we put in lookup tables. In this case, we have stores and departments in columns B and C in your fiscal calendar and F. Pretty simple stuff, but it lets us do VLOOKUPs later based on these tables. This particular tab is, we actually populated this using the trial balance method that I indicated earlier, I exhibited earlier. Again, I would probably use the Empower just because I find it to be, I don't have to run it 12 times, I can run it one time. That's the beauty of Empower, I can run it for an entire year as opposed to a trial balance, which you have to run by period. But as you can see, we have done a VLOOKUP to access this table, and it assigns a period. And then once the period's assigned, we spin it to a pivot. Now the pivot is great because now I've got sales by store, which you can't see because I've actually whited those out. Normally the store number would be right here, but for confidentiality purposes, I had to pull some decent data. You would have a store number here, obviously period across the top and department down the side. And what that allows us to do, and again, this is all part of this budget module, this budget spreadsheet, is it lets me pull up sales by period. Store 1, for example, I've deleted the rest or hidden it. What I like about this tool is it will let me, if I think, okay, I just want to add $10,000 of sales, you can see that it did. Or if I wanted to have it grow as a percentage, maybe we think inflation, God would all love some inflation, but maybe we think it's going to be 2.5% next year. So you can see that I put that in there, or if you add both, it'll do both. Or maybe in period 3, you've got a competitive opening in the area, and you think it's going to be, you're going to take a sales hit. So this allows you by period, by store, by category, to budget your sales with your sales team, your managers, whomever that may be, and it will then, based on some specific information you may have, and as by period or whatever it may be, and budget those sales. The next tab in this spreadsheet is it then summarizes the data you saw here into a much more concise format so that you can quickly see. Store 2, we have the following sales budget put together with a quarterly compilation of that as well, of course, along with an annual. And that, of course, is the first thing that most people do when they budget is they budget sales. So if I go to the summary, you can see the 356,770 is going to tie into our budgeting spreadsheet. So the budgeting spreadsheet is essentially 2 tabs, and I'm going to color these just for sake of visual enhancement. I'm going to put these in yellow. So this is we call it lookup tables. I really don't know why we call it lookup tables. This is really the assumption tab. Here, if I put in 20% gross margin for grocery, maybe I have GM at 35, I have beer at 11 because nobody makes money on beer. Meat's going to be 30%. It'll carry forward to the total budget, which we'll look at in a second. What we've done here that's nice is we put up and say, okay, this is department and GP, and it's and most folks, if you use the standard chart, 4310 is purchases. And so by putting this in this way, it lets you do it. In this case, if it has a percentage sign just before the account number, we want a percentage put in there. I don't want a whole dollar, I want percentage. And you can see we built in purchases, we've built in rebates. You don't have to use all these, but we tried to make it robust enough. So if you wanted to budget margin at the purchases level, at the rebate level, at the shrink level, or whatever you wanted to put in here instead of this, you could do it. Again, wages, we have department wages. Typically that's 5,005, 5,020 in our standard chart. We want percentages here. You put them all the way across for the year. And if you want, depending on the level of granularity you want the budget, you can do vacation, you can do sick time, holiday, and apologies, bonus, et cetera, et cetera. So again, you see the percentages, it wants percentage here. Advertising at 1%, supplies at 1%. And then we get down to normal supplies. Maybe it's laundry and linen. Maybe it's carpet change out, whatever it may be. Here you can see we change from percentage, and you can either put in a whole dollar. So maybe laundry and linen for you is a set $250 a month, right? Or maybe it's a percentage of sales. Whichever way you decide you want to budget it, pick a column, dollars or percent. It gives you the opportunity to do that. Obviously, that's very applicable in occupancy, where maybe you have rent, and rent is typically going to be a common dollar amount per period. Floor service is not based on sales. Most of these things aren't going to be based on sales. Utilities, electricity. If you want to do it as a percent of sales, you can, or you can do it as total dollars. Again, all of this information then feeds budget 2, which we'll look at in just a second. Budget 2 means budget for store 2. Excuse me. Same for administrative. You can do dollars or percent. A lot of this is a flat dollar amount, but credit card fees may well be, most likely is a percentage of sales, and we have other income. So once you put all of those percentages in, you can have it will feed automatically over here. Remember a while ago, I put this in just for ease of use. I put 20% in for grocery margin. Obviously, the reciprocal, that's 80, so purchases is 80%. We'll have that in, and it just feeds all this. If you chose to do rebates, if you chose to do shrink, and then of course this is a calculation. You can see that it takes sales minus purchases and plus the other minus the other is applicable. Salaries and wages fed based on the percentages or the dollars that you budgeted over here. This is the amalgamation tab, the combination tab. It works really well. I'm going to go through this quickly today. I'm not going to spend a whole lot of time, and at the very bottom of it, you will get to a bottom line for the store for that period and for the year. So again, we spent a lot of time developing this. It very nicely ties into the ability to pull raw data out of our system using the trial balance or using the Empower tool that we have built. So at the end of this session, Eric Ronsky will gather questions. If you have any questions for me on the budgeting stuff that we've looked at, I'll be glad to answer those at the very end of the session. I'm going to kick off here now to Dennis Hoyt. Dennis is somebody that we have as one of our functional partners that we have here at FMS. Very skilled in cash management, very skilled in doing RFPs for lenders. So he's going to walk us through now. Eric, if you give Dennis control, that'd be great. He's going to walk us through, cash planning and forecasting. And hey, I want to grow. I need cash. How do I go about getting, lending? What do lenders expect? What are they looking for, et cetera, et cetera. So Dennis will take the next 15 or 20 minutes and walk us through those components. Dennis, thank you, and welcome to the webinar.
Thank you. Can everybody hear me now?
Yep, hear you just fine.
Okay, good. Just a little introduction, everybody. Again, Dennis Hoyt, Treasury Services here from snowy West Michigan. And on that first slide, just a real quick introduction. Of course, you guys know what FMS does. I'm a sole proprietor, treasury consultant. I've been doing this for roughly about 20 years now, focusing on retail-related industries, working kind of as a treasurer for hire, if you will, and working on both small and middle markets. Treasury consulting outside of your daily management of cash, most treasury is project related, whether it's related to financing or maybe developing a forecast or reporting models, looking at analyzing cost benefit and helping implement new products like a pay card, smart safes, electronic deposit, things like that. And then other things that are not necessarily done internally ever as maybe cash treasury management reviews, that sort of thing, and as well as RFPs. So this basically is a nutshell, real quick intro. That's the kind of thing I do. On the cash planning and forecasting, John had asked me, he and I talked a couple months ago, and he asked me to take a presentation from another group that I went and folded into this. So that's where we are right now. Basically, where we are right now, cash planning, situation awareness. Let's say cash is very tight, either whether it's this time of year or any time really. There can be a lot of possible causes: sales, seasonal issues, merchandise, vendor problems, or the unexpected payment, etc. And these are not black swan type of events. They happen to most companies, and they catch you off guard, though, or certainly they can, if especially maybe a couple of them happen at the same time. So bottom line, you're reducing your cash flow and or your availability, and so you need to do something about that. The something about that is, basically you've got to figure out where you are reporting wise, and then also figure out what you need to do to attack the situation. Reporting wise, you've got to make sure you've got a good daily cash report, I call it DCR, that will show both your ledger and available cash balances and receipts, disbursements by both day and maybe by type if you can. The DCR, it'll give you a good history also of daily activity and balances. And then also, again, we're assuming that you're in a cash tight situation here. You want to do some quick and dirty cash forecasting by day, say 1 to 2 to 4 weeks out. So you can figure out, okay, what do we need to do to get through the fire on this situation, to put the fire out. Cash flow is tight, so you're going to forecast cash activity balances by day until things improve a little bit. You'll take your sales or forecasted sales by day, convert those to actual receipts because you've got your check and credit card delays, etc. And you want to make those fairly conservative. And just to be on the safe side, disbursements, again, you want to forecast what payments are going to clear, not what you're going to issue, but what's going to clear. And try to give yourself a little bit of an audit trail to forecasting disbursements by type, whether it's merchandise, general, taxes, rents, etc. Okay, so you're now putting down some reporting historically where you are. Okay, so what kind of actions do you need to take or should you take? First thing, cash. Find out what excess cash you have. Every time I go out to a grocer, I can almost guarantee they've got too much cash at the store, especially if they're cashing checks. And I don't mean, again, we're not talking checks at the lane, but rather at a customer service booth. Whenever they cash checks, from those people, from their point of view, cash is their inventory, and they don't want to run out of inventory, so they hold plenty of cash, usually too much. That's one area. You can upstream to corporate excess cash there. Also, maybe take a look at your armored carrier pickups and see what you can do there. It could be some of those are delayed more than they should be. Also, your bank's daily cash reporting at the end of each day will show you excess cash that was maybe available that you didn't tap into, or maybe you effectively borrowed too much, and so you need to go back and kind of rethink what you're doing there. In prioritizing payments, of course, I mean, clearly payroll is probably number one. You can't delay that, but look and see if you're pre-funding the payroll account. Payroll account, whether you do it internally or outsource it, sometimes a company will pre-fund on a Thursday 100% of their payroll. And direct deposit will go out automatically the next day, and maybe pay cards, et cetera. But when you're talking about payroll checks, those you can look historically, and it's usually pretty smooth. You can forecast that pretty well, that maybe 50% of the payroll checks clear the first day, and 20% the day after, another 20 after that, et cetera. So you don't necessarily want to pre-fund the payroll account for payroll checks, but rather just kind of fund that as you need to, and suddenly you've got a little bit of extra cash in your concentration account. Obviously, taxes and most merchandise payments are a priority. Delaying other ones, CapEx, you could probably delay those. General AP, certainly you'd want to look at that. Early payments, if you're taking discounts, even if it's a really good discount, you may want to stop doing that and just paying a little bit later and give yourself availability there. And then when things loosen up a little bit, that's when you can go back and take the discounts again. And maybe even delay vendors if they're merchandise vendors, if they're what they're selling you, if you've got basically too much of it on hand. And obviously consider talking to your wholesaler and maybe even your bank too, depending on the situation. So once you're out of that, so let's say, okay, now you're out of the deep stuff. The worst is behind you, but you realize, okay, we probably still need a good forecast. Instead of a daily forecast for a short horizon, now I'd look at a weekly cash forecast that would be for, say, 3 to 6 months, 3 to 6 periods, where you can think longer term. At that point, okay, revise it. Again, you're still measuring cash flows but weekly now instead of daily. Purpose of that forecast, obviously it'll help you decide if you've got enough cash for operations or if you've got to go back to the bank and maybe borrow more, increase your line. It'll help you also do some what-if modeling. So say, okay, in your budget, maybe you're forecasting comps of 1 or 2%. In your cash forecast, you can change that and maybe reduce it to 0% comps or what have you, and just see what the effect of that would be. And also a cash forecast, it'll help you borrow at a lower rate, meaning if you see that you need a minimum $5 million borrowings over the next 3 months, say, instead of borrowing on a daily basis at prime at a higher rate, you can maybe borrow at 1 or 2 or 3 month LIBOR at a little bit lower rate and save yourself some interest expense there. Next thing here, just relying on the financial statement forecast or budget. Those are important to have, but I wouldn't rely on those solely. There's 2 major differences. The first is you can see that a forecast can be prepared on a weekly basis. Financial statement forecast or budget is usually monthly or a period basis. And obviously the intra-month cash swings can be very large, due to first week or 2 EBT sales or payroll every biweekly or rents at the start of the month or the end of the month or whatever. In a financial statement or budget year, that's going to be hidden as far as timing, whereas weekly you'll be able to see that and be able to plan better. And also the other thing too is a cash forecast shows the real cash balances. Financial statement forecast or budget tends to kind of tie into book cash a little bit. And if the difference between real and book cash, if you've ever, well, of course you have, think about your bank reconciliation. Your bank number, that's your real cash, if you will. And you have to play with in your book cash, whatever those adjusting items, that shows you what the difference is between the two. And usually it can be pretty large. Now, I've been pushing a little bit of cash forecast, but on the other hand, you may not need a cash forecast if you've got a fairly consistent positive cash flow, or maybe you've got no debt or good availability on your line, your bank line, or maybe if you don't really have any large expenditures on the horizon. That would be your call, but still, usually you'd want to forecast, but it's not for everyone necessarily.
Dennis, so one thing we offer in our system, and I get calls like this all the time, is one really good way to do a quick and dirty. I love cash flow statements. They tell you from whence your cash came and to where it went. If you print for yourself or run for yourself in any either per period or quarter a trial balance report, you can quickly do some rough work in Excel to say, where did my cash go? I generated my 4,000 to my 9999 series. I generated revenue, right? But where did my cash go? I can look at my delta, and the way our trial balance works is it's got the middle column is the net change of the period that you run it for. So if you see a $222,000 increase in fixed assets, holy cow, that's where my cash went, right? It's a great way to quickly show management or yourself, where did my cash go? So you can then from a future-looking standpoint, help do some of the cash management that Dennis is talking about, the cash forecasting that Dennis is talking about. It's a really good tool to use it all the time for that.
Mm-hmm. Okay, good. On this next slide here, what should a forecast look like? You don't need a whole lot of line items. Again, columns, it would be on a weekly basis, not monthly or by period. Line items, receipts, just collections on sales and then other receipts. And remember, your incoming cash is receipts. It's not your sales. You'll start with your sales and then revise that for timing and other purposes, but it's receipts. Outgoing cash is disbursements, not expenses. Again, you think just cash. And unlike accounting, too, you're not matching revenues and expenses or even receipts and disbursements. You're just putting those down where they lay. Disbursements can be, weeks before your receipts, related receipts, or weeks after. It all depends. Your biggest line item, again, sales. You'd start with your prior year comp store sales. That's probably where I'd go. Adjust that for maybe changes in your store counts, receipt timing, again, like credit card or checks, and other factors. Other receipts can vary, but they would include sales taxes. Again, whether it's your effective sales tax rate is maybe 2% or whatever it may be, you'll collect that pretty much on the day of the sale or the day of the receipt. But on the other hand, you won't be paying that sales tax out for maybe several weeks down the road, which would be in your maybe other disbursements. Again, merchandise, you probably start with the cost of sales and then have to adjust that for non-cash items, expected payment timing, things like that. Payroll, actually, that's pretty easy to forecast. You're going to look at that on recent history of payroll clearings and any seasonal expected changes based on hiring volumes, etc. Rents, again, pretty easy to forecast overall. Construction, that if you're having any capex, new store changes, etc., again, you've got to basically take the amounts and then adjust those for timing and payment, construction timing, payment timing, etc. Taxes, again, you would know the timing of those, the amounts. You've got to look at that internally. And loans, principal and interest, again, for term loans, you should know the timing of both and amounts for both principal and interest. And on a revolver loan, you would know the timing of the interest payments, and then the actual amount of revolver principal, whether you're borrowing or paying down, is going to be a result, kind of a bottom line result of your cash forecast. And then other disbursements, that's pretty much everything else that you need to put in there. On the updating the forecast, again, we're talking a weekly forecast. I would update the forecast weekly with prior week actual ending balances for cash, debt, and any investments. You need those new bottom line beginning balance numbers to do that. There's no question about that. Every 1 or maybe 2 weeks, I'd revise the forecast going forward for major line items, again, sales, merchandise, etc. Maybe every 4 weeks, expected changes in other line items, and then quarterly, at least quarterly, you want to update the forecast in its entirety. A few comments: I would not overlay actuals, historical actuals, onto the prior week's forecast amounts. Why bother? I mean, I've used to do that in the past, and basically it's just taking a lot of time. It wasn't really offering any benefit. Again, you want to look ahead, not back. On the other hand, if there's a significant difference between actual and a forecast, then you want to probably look into that a little bit. You can easily determine, or you should be able to fairly easily determine, if there was a change in sales. But if your, say, general disbursements were quite a bit higher or lower than what you'd forecast, then you probably want to look into that a little bit, investigate that a little bit, and see what changed that you did not plan for. And also remember in updating a forecast that if an expected payment took place last week that you had forecast it to take place 2 weeks from now in the future, then that 2 week that amount, you need to adjust it in the future, so it's so you're not expecting to pay it again a second time. Okay, next thing on to lending packages and strategies. Basically, and again, let's assume now that forecast, you're looking at that, and you're basically, whether it's your current bank or some other bank you've gone to, and it's been decided that, hey, you need to increase your line, $1 million more, double it, or whatever it may be, or maybe there's somebody's come to you and you need some new CapEx expenditures, what have you. So you need more borrowing power. Hopefully, you've been talking to. Well, let me just say one thing right now. If you're banking with, you've got your incumbent bank, and you have other banks that have been calling you every 3 or 6 months, and you haven't really been talking with them, and you've not, they could be your future bank down the road. So I would recommend that when these banks call on you, even if it's just to go out for a quick bite to eat or a cup of coffee or something every 3, 6 months or whatever, you start taking them up on their offers. It would be a real good time to, when you don't need to borrow from them, it's a real good time to kind of start to lay the ground and let them get to know you and vice versa. So a first meeting with a bank, you want to give them both, obviously, some general information, where the company is, a little bit of history, upcoming events, basically, public information. The bank could probably get this off the internet if they wanted to. Maybe a few feel-good stories about community service or involvement, that kind of thing, too. Also, then, confidential information, where the company is, and the purpose of this is to show them how on top of things you and your bosses are at the company, who your vendors are, customer demographics, any problems. Everybody has problems, so feel free to discuss those. Trends, be they good or bad, plans for the future, what you're going to do to address any negative issues coming up, etc. And again, why you want to talk to them. Feel free to be honest and open with them. You may want to ask for how they're going to keep this information confidential. So you may want to give them an NDA or just kind of feel them out for that non-disclosure agreement. Also, you want to give them some recent financial statements. I would suggest that the most recent year ended, that you give them that information by quarter. Years prior to that, maybe 1 or 2 years prior to that, you can just give them annual information. They will feel free to come back and ask you for more information, so don't feel like you've got to put everything together the first time. Then also management. You want to bring in your top 1, 2, maybe 3 people. That I would view as probably one of the more important things, because the last thing a bank wants to do is walk out feeling like the CEO is too busy to talk to them. And you can maybe get by with it on the first meeting, maybe a second, but that bank is going to want to meet the top people, and it definitely generates some goodwill if the CEO or the president or whoever can come in and even for a couple minutes just shake hands, introduce themselves, and give them a little information about themselves and what have you. Again, so a good face-to-face is a real good idea. Okay, on to the next slide. Let's impress these guys. I would recommend giving them 2 things that is going to really help them understand your business better and let them realize that you've got a pretty good feel for it also. The first is a flow chart and of the bank accounts that you have currently. You want to go ahead and give them that, and I've got an example on the next page. It'll show that receipts coming in, the transfers between accounts, and then the disbursements going out, and a little bit of timing, things like that. That will really help them understand exactly what they're looking at here as far as your needs, things like that. Secondly, I would give them a couple months worth of your account analysis statements modified. Account analysis statements, that's the bank's invoice. You get those at monthly, maybe just quarterly, but probably monthly via electronic email. And that is, again, the bank's invoice. It shows all of the bank's services provided by bank account and the pricing, the itemized pricing, and the total pricing for each service. It also shows the average available balance maybe for that month or year to date, etc. What you want to do in giving that information out, you want to black out the itemized pricing and the total pricing and the balances. But what you're going to do is then the bank will see, okay, your bank that you're talking to across the table, they'll be able to see the services that are offered, the volume, the transaction volume for those services, and for each bank account. And that is critical because that will help them determine what additional income they can make off the relationship with you. Give them additional reasons as to why they want to come on board. You're going to ask them about some pricing related to that a little later. Here is an example of a flow chart I put together for a client a few years ago, done for a grocer. Again, like I said, just real simple, just 4 or 5 bank accounts, and it shows the ins, the transfers between, and the outs, a little bit timing also, and it really helps the bank. They last time I did this, they just were very, very pleased the fact that they just said they couldn't. Usually they've got to ask a client numerous times for something like that, or put it together themselves and hope they've got it right. And again, then the account analysis statements really help them understand the whole thing too. On this next slide, the confidential information that the borrower needs, your loan request. Again, you're not dictating anything to them. You're just documenting again what you're looking for to the extent you can. Do you want a revolver and or a term? Purpose of the loan, when you'd want it in place, how long, a term note, 3 years, 5 years, whatever it may be. And again, you don't want to come across like you need to be borrowing these funds right away. That could send up a red flag. It probably would. An exception to that is if some older guy, store owner, 2 towns away, he's got 3 stores and he's said he's going to retire, and he's talked to your owner and said, I'd like to sell you my 3 stores, and you need the cash to buy them. Okay, that is a very good reason to go to the bank and say, we need something ASAP, and here's why. So, but barring that type of good event, you don't want to, it could be a red flag if you were to say you need something ASAP. Again, you don't, or I would say you do not want to ask for pricing on services right away. You gave them those account analysis statements so they can estimate how much more they can make by lending to you. I mean, I wouldn't put it in those words, but that's the purpose there. Give them a little bit of a hook there. On the other hand, when they do come back and say, if you've got maybe a couple banks bidding against each other, that's when you want to say, okay, now give us, here's the pricing you're giving us on the loan facility. Okay, fine. Now let's take a look at all the other services. Give us some pricing on that, because those really add up. You would be really surprised about that. So again, and the other thing too is with the account analysis statements, giving them that and the flow chart, feel free to ask them to come back to you with better ways, their ideas on better ways to utilize banking services. Because they may just come back with something that, in addition to, here's our loan package, here's some other services we can offer that your current bank does not, or whatever, and save you money that way. So, can make it a real win-win. Their response, again, maybe they're not interested. If they're not interested, you really want to try to find out why. It could be something that is easily correctable. Maybe you can't get them interested right now, but it's something that for the future you could correct it within a reasonable period of time. Small thing. Or maybe even just a miscommunication. And again, worst case, it just kind of teaches you a lesson about something that you need to make change next time around. Or if they are, they're going to say, okay, here's a 3 to 10 page term sheet, and here's the various terms, maximum loan amount. Maybe it'll have a cleanup provision, which is where the bank would say, okay, we'll give you a $5 million revolver, or $20 million, whatever it may be, but you've got to be totally out of it, say, for a 30-day period sometime during the year. That would be like a clean up or clean down position or provision. Also, lending conditions, the debt, all other debt has got to be subordinate to the bank debt, or here's the guarantees, partial guarantees that we want from the owners. Also, then there's, again, loan amounts, interest rates will be on their reporting requirements. It could be that they'll want monthly financials, maybe a weekly borrowing base that would be tied to the inventory levels, limiting the amount you could borrow. Limitations maybe on CapEx or limitations on distributions. Negative covenants, say loans, you can't make advances, and you can't give loans or only on up to a certain amount to your, say, officers, etc., or no other debt you can borrow on, no other debt. Or some of the covenants too, there may be a minimum net income covenant, a minimum EBITDA to fixed charges, or a maximum funded debt type covenants. You would expect to see something like that. And then finally, we're just about there. After it's over, what you've agreed to a term sheet, you've signed off on it, and the bank has given that term sheet then to their attorney, either in-house or outsourced attorney, who's put together a draft of an agreement. They ship you the draft. You guys negotiate it back and forth a few times, agree on something. And then when it's over, I would recommend, again, preparing some kind of a summary by topic of the ongoing requirements of that agreement. Again, ongoing requirements, a conditions precedent, meaning something has to take place before close. That's not an ongoing requirement unless it's got to take place, say, or occur 45 days after close or so. But basically what you need to do going forward, you want to document those in a summary form. And also, by topics, which would be maybe borrowing procedures, dividends, distribution limitations, how interest rates are calculated, maybe negative covenants, events of default, things like that. And then also, I would suggest including some kind of a calendar for the next year or so. After that, it's kind of a copy job, but a calendar that would show when your payment and reporting requirements are by day. You'd be able to calculate that by day. And then also, those are date-specific requirements. Others may be event-specific, which I would call something like where there's a contingency in there, meaning if the bank says if you're sued for more than $25,000, you need to notify the bank within 5 days, that kind of thing. That's what I would call an event-specific requirement. You want to document those as well so you can make sure you're in compliance. And even then, you may find out, you may look through that agreement and realize that something's amiss, something is, you just didn't work on it, didn't count on it, etc. So if it's critical, kind of a deal killer type thing, you want to get back to the lender ASAP, try to get it amended immediately, because it doesn't help the lender at all if for whatever reason you're out of compliance in 3 months. It makes them look bad as well, so to their bosses. So just go back to them and say, we didn't negotiate this, we don't agree to it, etc. We need to amend it, if it's a critical thing. If it's not really all that important, but still you want to get it changed, put it on the list, maybe notify your banker, but say that when we maybe amend the agreement in 6 months or a year or whatever, this is something we want to make changes to or discuss at that time. So, John, I think that's pretty much it. On that next slide, that's a little bit of information, contact information. And John, I've taken a little bit of time here.
Well, thank you. Thank you, Dennis. I've worked in a number of situations where, to Dennis's point, that you can have a financial default, meaning you don't pay your debt, but technical default, meaning you get out of compliance with some of your covenants. That a bank can and will call loans for technical defaults. Oftentimes they'll use that as a chance to charge forbearance fees, going, yes, we'll waive that this year, but that's going to be a $50,000 fee. I work for a couple of large companies that's exactly what happened. So to the point Dennis made earlier about cash modeling and cash forecasting, you should absolutely do the same thing when you're entertaining loan packages to see if you can indeed stay in compliance with the covenant. That is a big deal to a bank. So, Dennis, thank you. Certainly, if you guys have the attendees on this call today have need for treasury services, Dennis does a great job. He's done it many times in many circumstances, big and large. Would be a wonderful advocate on your side for bouncing ideas off of, or even helping in the fine print that goes